I'm Carmelin Ziswan from DSBA Marketing Management. Low prices. Low price encourage many customers to buy your products and services by making them affordable and offering them a reason to choose your products over those of your competitors. A low pricing strategy enables you to set low prices for your products to attract more customers and increase sales. Regarding low prices, there are two issues. First, how do we determine whether costs are covered? To address this basic question, we will compute of a break-even simple math computation that determine how many units we have to sell to make money. The second pricing issue is whether low prices are a constant strategic choice, such as every low price providers add fees who position themselves around good value in the minds of customers? Or should we pulse the market with price fluctuation, offering and rolling back temporary price discounts? We discuss break-even first. Ang low price kasi ay ang pagbaba ng presyo sa mga mamimili o binibenta na products. Low price points come from Number 1. Cost plus pricing. Markup above average cost. Cost plus pricing, also known as markup pricing, involves calculating total costs, then applying a markup percentage to those costs to reach an asking price. Number 2. Loss leaders sell below cost to bring in customers who will purchase other products. Loss leader pricing is a marketing strategy that prices products lower than the cost to produce them in order to attract new customer or to sell additional products to customer. Number 3. Market penetration. Price low to attract volume. Market penetration is a measure of how much a product or service is being used by target customer compared to the total estimated market for that product or service. Number 4. Early the product life cycle to generate buzz and demand. The first stage in the product life cycle is development. Number 5. Late in the product life cycle to milk profits before the brand dies. Number 6. Nearly predatory price low enough to discourage competitors. The strategic objective is to maximize sales volume to spread fixed costs over as many units as possible, while maximizing per unit to margins. That's all. Thank you.
Concept in action. Break-even for a good. So what is break-even or BE? A break-even analysis is a means of figuring out how many units you'd have to sell before you make back your costs. Here's a true experiment to illustrate. Say you're heading out of town to meet a client. You can take a cab from your place or you can drive to the airport. Say a cab costs $20 plus $5. And it costs $20 a day to park in your city airports for parking a lot. Pretend gas is free. For trips of what length is the smart cost efficient to drive and park at the airport? A break-even analysis will provide fodder or for consideration such as price and cost adjustments. It can tell you whether you may need to borrow money to keep your business afloat until your packaging profits, or whether your endeavor is worth pursuing at all. A break-even analysis is a financial calculation that weighs the cost of a new business, services, or product against the unit sale price to determine the point at which you can will break even. In other words, it reveals the point at which you can have to sold enough the units to cover all of your costs. At the point you will have neither lost money or nor made a profit. A break-even analysis is a financial calculation used to determine a company break-even point or BEP. It can international management tool, not a computation that is normally shared with outsiders such as investors or regulators. However, financial institution may ask for it as part of your financial projections on a bank loan application. The formula takes into account both fixed and variable costs relative to unit price and profit. Fixed costs are those that remain the same no matter how much the product or the service is sold. Example of fixed costs include facilities rent or mortgage, equipment costs, salaries, interest paid on capital, property tax, and insurance premium. Variable costs rise and fall according to change in sales. Example of variable costs include direction hourly labor, payroll costs, sales, permission, and costs for non-material utilities and shipping. Variable costs are the sum of the labor and material costs it takes the product one unit of your product. Total variable cost is calculated by multiplying the cost to produce one unit by the number of the unit you produce. For example, if it costs $10 to produce one unit and you made 30 of them, then the total variable cost would be 10 times 30 equals $300.
Good day everyone, my name is Gemma Rose Dilumasag and I'm the third reporter. Break-even point for a service. Services are tricky because they are notoriously disproportionately high in variable cost. As a result, the cost numbers will move faster with an increase in demand. What is break-even analysis? Break-even analysis is a financial calculation that weights the cost of a new business, service, or product against the unit sale price to determine the point at which you will break even. In other words, it reveals the point at which you will have sold enough units to cover all of your costs. At the point, you will have neither lost money. In figure 9.7, it shows the variable cost. In the previous example of the portfolio, there were variable costs as well, but they were smaller than for these tablet examples. In cost, the store staff time to load the software, given their salaries and their time, say that averages out to about 30 a tablet. And the store must maintain legal licensing fees on a variety of software package. And contains the differences in profits. This analysis could be refined using continuous numbers rather than rough numbers. Contains the differences and profits. This analysis could be refined using continuous numbers rather than rough numbers. Similarly, the prices charged could be assessed in a more refined manner with a continuous scale. But again, the discrete price points give us the sense of the break-even problem. In figure 9.9, let's take a look at the money we'd make. First, note that $30 is just a totally ridiculous baseline. We'd lose money fast and as we serve more machines. We'll lose more money if we change $50, we're still not doing well. Increase the charge a little more to $100 and we can make money if we customize 30 ebook readers or more. We will compute this in a more refined manner in a movement, but just looking at this table, to break even we'd have to change at least $100. Later, when we talk about the values customer or their willingness to pay, we can figure out whether we could change just $100 or even more. Sample problem. B equation. Fixed costs are 2,000 and variable costs are 33 point for a price of 100 for the service. Round that up to 30 since the table customers are integers that the number of units we'd need to sell to break even. Break even are usually computed in terms of quantity we need to sell if we wanted to see the revenue required for the break-even point. We merely translate our figures by multiplying the break-even quantity by the price point under consideration. Figure 9.10 shows the break-even goal in terms of linear function from which we may interpolate. The number of units sold from the horizontal axis and money form the vertical axis. The first horizontal line in the graph itself shows the fixed costs steady across all number of units. The line labeled total cost includes these fixed costs and have an increasing slope because they also reflect the variable cost which increase with numbers of units produced and sold. The revenue line is our income and the point at which this line intersects the total cost line is our break-even point as we computed right at 30. Break-even analysis should be performed for every price decision to understand the lower bounds. Let's turn now to the upper bounds.